Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Super Hi International Holding Ltd. Annual Report. Super Hi International Holding Ltd. is a diversified investment holding company with a presence in multiple regions worldwide, including Asia, North America, Europe, Oceania, and internationally. At its core, the company operates restaurants under its flagship brand, Hi, which offers a unique dining experience to customers. In addition to restaurant operations, Super Hi International Holding Ltd. also provides food delivery services, catering to the growing demand for convenient meal options. The company's product portfolio extends beyond food delivery, as it sells hot pot condiment products and branded food items under its Hi brand and secondary brands to both local guests and retailers. The company's business model is designed to cater to diverse customer needs, from dine-in experiences at its restaurants to the convenience of home delivery. By offering a range of services and products, Super Hi International Holding Ltd. has established itself as a significant player in the food and beverage industry globally. Super Hi International Holding Ltd. maintains a market capitalization of $7 billion, broadly in line with the industry peer group. Super Hi International Holding Ltd. trades at a higher price-to-earnings ratio of 25 times and a lower price-to-book ratio of 1.69 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The company maintains a moderate leverage profile, with liabilities making up 47% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth and decline can be identified through an analysis of various factors. On the growth side, expansion of operations is a significant driver, with 13 new restaurants added, resulting in increased revenue. Additionally, same-store table turnover rates have improved, leading to a 2.9% increase in same-store revenue. Customer loyalty schemes and redemption of loyalty points also contribute to revenue growth. Furthermore, sales from restaurant operations, food delivery service revenue, and the sale of prepaid cards and vouchers all contribute to revenue growth. Regional variations also play a role, with countries such as Malaysia and Vietnam experiencing significant increases in revenue. On the decline side, disruptions to restaurant operations have resulted in lost sales and revenue decreases. High temperatures have led to increased energy consumption and costs, while difficulties in food preservation have caused food loss and declines in production efficiency. Consumer preferences shifting towards low-carbon and healthy options have also contributed to a decline in demand for traditional high-energy consuming or high-emission products. Regional variations also play a role in revenue decline, with Singapore experiencing an 8.4% decrease in revenue. Overall, these factors highlight the importance of operational efficiency, customer loyalty, and adaptability to changing consumer preferences in driving revenue growth or decline. The company's financial performance indicates a positive trend in its operating cash flow. According to the provided data, the cash generated from operations has been steadily increasing over the years. In 2025, the company reported $127,668 in operating cash flow, which is slightly lower than the previous year's figure of $131,317. However, when looking at the net cash generated from operating activities, we see a more significant decrease. The company reported $114,648,000 in 2024, down from $119,696,000 in the previous year. Despite this decline, the company is still generating positive operating cash flow, indicating that it has sufficient funds to meet its financial obligations and invest in growth opportunities. Overall, while there may be some fluctuations in the company's operating cash flow, the trend suggests a stable and positive performance. This is a reassuring sign for investors and stakeholders, as it indicates that the company is well-positioned to continue generating revenue and meeting its financial commitments. The company's debt level and interest expenses have undergone some changes over the past year. According to the financial reports, there has been no significant change in debt level as of December 31, 2025, with no bank borrowings or committed credit facilities. However, a closer look at the numbers reveals that financial liabilities did increase from $61,741 in 2024 to $70,648 in 2025. In terms of interest expenses, there is no clear indication of any change. The reports do not provide explicit information on interest expenses for either year, making it difficult to determine if there has been an increase or decrease. Overall, while the debt level has increased slightly, the lack of information on interest expenses makes it challenging to assess the impact of this change on the company's financial health. The performance of various regions in the industry has been analyzed based on extracted summaries. Regions that performed well include Southeast Asia and North America. Southeast Asia recorded a significant revenue growth of 56.3% in 2025, with an increase in total guest visits and average spending per guest. Additionally, same-store sales increased by 0.5%. In North America, there was a notable increase in average daily revenue per restaurant, along with a rise in same-store sales by 2.1%. On the other hand, East Asia and others underperformed compared to previous years. East Asia experienced a decline in revenue growth from 16.7% in 2024 to 16.4% in 2025. Furthermore, total guest visits and average daily revenue per restaurant decreased in East Asia. The region also saw a significant drop in same-store sales by 18.6%. Others also recorded a decrease in revenue growth from 12.9% in 2024 to 12.8% in 2025. Management is optimistic about the company's outlook and strategy. The Pomegranate Plan will continue to be a key focus area, with investments in diverse business concepts and resource strengthening. This plan aims to drive growth through employee engagement and customer satisfaction, while also implementing the dual focus on employees and customers operating strategy. To further enhance growth, management plans to identify strategic investment opportunities and acquire high-quality target businesses that create synergies for the group. Digitalization and service upgrades will be promoted to optimize customer experience, with a focus on creating a comfortable dining space through innovative design concepts. In addition to business growth, management is also prioritizing sustainability and safety. A top-down management system will be established to ensure comprehensive coverage of work such as goal setting, safety training, and emergency management. The company will also implement waste sorting and compliant treatment in global restaurant operations, with a focus on reducing waste and promoting sustainability through measures such as repurposing ingredients and introducing biodegradable disposable items. Overall, management strategy is centered around driving growth while prioritizing sustainability and safety. By investing in diverse business concepts, acquiring strategic assets, and implementing digitalization and service upgrades, the company aims to create a strong foundation for future success. The company's financial performance for the year ended December 31, 2025, reveals a notable trend. One key aspect is that no dividends were paid out to shareholders during this period. This decision suggests that the company may be prioritizing other uses for its profits, such as reinvestment or debt repayment. In terms of share buybacks, there is currently no information available in the provided summaries. It is unclear whether the company has engaged in any share repurchase activities, or if it plans to do so in the future. Concerns about inventory buildup or supply chain disruption are evident throughout the extracted summaries. On page 29, it is noted that inventories increased by 19%, while on page 30, the company's inventory grew by 15.9% in 2025. The data on page 37 shows a significant increase in inventory levels from 10,343 to 18,472. Furthermore, pages 88 and 200 highlight potential concerns due to supply chain challenges that differ from those encountered in the core hot pot business. On page 198, specific concerns are listed, including loss of sales, inventory backlog, extended receivables, net cash flow decreases, increased costs, and squeezed profit margins. The increase in raw materials and consumables used by 9.5% from 2024 to 2025, page 243, also suggests that the company is struggling with supply chain disruptions. These concerns indicate a pressing need for the company to address its inventory buildup and supply chain issues to maintain profitability and competitiveness. That concludes the financial summary for Super Hi International Holding Ltd. Feel free to comment below, and I will be happy to answer them when possible.